Hello, everybody. Welcome to my print hash for week 26 of 2026. I'm your host, Cameron Otsuka, alongside Matt Dines, as always. This week, we're going to dig into SpaceX's bond offering. They announced this a couple days ago, and what that means for the US dollar's capacity or ability to fund the AI buildout. We'll then expand from there into kind of broader monetary rails. We'll talk about movement on the euro, yuan, dollar fronts, and then finally rounding out the episode with what the future holds based on some developments that Matt was able to identify in FHLB, Federal Home Loan Bank data. But before we get started, I wanted to start by mentioning that Matt was actually on the What Bitcoin Did podcast with Danny Knowles. If you already subscribe or listen to What Bitcoin Did, then you will see that coming up in your feed here soon. But be on the lookout for that conversation with Matt. I think as always, Matt is able to drop a lot of good insights, and knowing Danny as a watching his podcast and all of that, I know he asked very good questions, so I think it's going to be a good one for everybody to learn more about, uh, you know, from Danny's perspective. But all right, well, with that all said, let's get right into it. Matt, I'm going to flip over to our slides here. Um, SpaceX was the big news, both on the IPO front, but also from the bond market front. So headline, just to read it out for everybody here: SpaceX hits bond market for $25 billion. Matt, take it away.
Okay, so Monday this week, we had the large debt deal placed in U.S. dollar investment grade credit markets from SpaceX. That came, within 6 days, 7 business days of the massive IPO, biggest IPO in U.S. stock market history, where the company raised $87.5 billion, right? So massive cash liquidity buildup, if you think about it that way. Um, and then this week, we saw the company in a five-part deal tap credit markets for an additional $25 billion. So we've been covering this story where that AI build out would increasingly begin to consume capacity in the US dollar investment grade credit markets in the years ahead. Um, this is just a reflection of that process continuing to build up steam. But like this trend is in full swing as this AI build out continues. Just it's going to not just count on the capital markets deals we saw in the past. It started out as venture equity, private markets fundraising, that type of thing. 2025 was the story of the related party transactions where, say, company A would sign on to some like a revenue deal, future obligations, and then exchange that for equity shares in company B. We've moved on at this point. Now we're going to IPO route. That's out of the gate. SpaceX started that, and now we're into that credit market capacity taking as well. So you can see the top 8 deals in U.S. dollar investment grade markets in the first half of this year. Seven out of the top 8 are all the large cap names involved in this AI trade. Everybody except for Abbott Laboratories on number 8 for $20 billion dollars. So, and then in the big picture, in terms of issuance for new money creation and U.S. dollar IG credit, June of 2026 is within $2 billion of the record high, which was set in June of 2020 for fundraising. So remember, that was in the post shutdown QE, fiscal spending, CARES Act, bonanza, money printer deluge, all of that of the COVID era, right? June 2020, we're already like we're going to set the record. We have 3 more business days. We got to do one more, small deal, and there will be one or two or more that go off on those calendar days, Monday and Tuesday, especially. So expect US dollar credit markets and the investment banks to put up a new record fundraising month for capacity and investment grade credit. So the next thing I want to cover, the use of proceeds for the SpaceX debt. So remember, they pulled 87.5 billion. They have a giant cash hoard now, which is going to come into play. We'll talk about credit markets and everybody's rush to raise dollar liquidity for whatever's in front of us. More on that to come. But the use of the proceeds from this, five-part debt deal this week actually went to pay off a bridge loan from the same investment banks involved in, book running for this week's deal, the 25 billion. It like that bridge loan was actually to pay off higher yielding loans involved in, prior debt accumulated by X and XAI. So this is a story, if you think about it, of corporate strategy, buildup of this Elon Musk, related project behemoths, like touching on, the satellite launches, rocket, what's the technology, like the recoverable landing, all, yeah, all of that. It's all, you can see this thing building up. This is a story decades in the making, really, if you think about it in the big picture. But this specific debt offering, the 25 billion, most of it was already spoken for. That it's basically a transfer, a rollover of your old debt for business decisions in the past, and now we're slowly starting to tap the U.S. dollar investment grade credit markets. Note that time was of the essence here, and you can tell that because of how they raised this debt. So they went for the 144A and Reg S offerings or elections for these offerings. What that means is you don't have like the formal SEC registration. Like you didn't go through the process of like a public bond market prospectus, or all of that documentation and approval behind this offering. They went for like a fast track election, the 144A. So for onshore regulated entities, essentially what you're doing is you're limiting your addressable market of dollar capital coming into $100 million or above balance sheets. So think about who would be buying these bonds. It'd be like banks, asset managers, pensions, um, insurance companies, et cetera. But like small mom and pop accounts who might buy a public bond offering, they would be limited, assuming that the account hasn't met those criterias and checked all the boxes for 144A eligibility. And then you have the Reg S component, which is for offshore, similar type of balance sheets and clients being able to deploy and raise from. So it's purely like a regulatory kind of exercise, but it is an election that or a choice, if you will, that is locking you into which pools of capital you can pull from. But what we saw here, right? This thing was massively oversubscribed. There was plenty of capacity to raise this 25 billion that SpaceX needed to then pay off the bridge loans, which were coming directly from the balance sheets of the five investment banks who were supporting this deal. So, um, key thing here right now, these bonds do not have future registration rights for a conversion to like public debt offerings, kind of like a conversion, right? Which is important because they're not yet, like, these bonds aren't eligible for inclusion in the Bloomberg US Aggregate Bond Market Index, which is kind of everybody's proxy for bond market returns, right? So there's
Right.
even a bigger boss that these could tap into. There's a whole nother pool once they flip over from 144A and Reg S to the public debt offerings. All right. So yeah, you can slowly see all of the Elon Musk led side projects starting to roll up into this like behemoth. And then that thing is the vehicle to fund all of this stuff, the satellites, the AI, uh,
Yeah.
Tesla, robots, all the, like
I
it's
saw
all
there's
coming
talk on
towards one
Tesla
thing.
too, and I think that one seemed like there was some more nuance to it just because of the structure. I think Elon doesn't own as much of it, things like that. But yeah, I mean,
Mhm.
tucking everything into one kind of thing that Elon is effectively the full owner of is an interesting, new development. I feel like for in the world of finance.
So he's our modern day version of Howard Hughes is how I kind of think about it.
Yeah.
All right, if you're trying to put this to historical proxies. All right. So the SpaceX bonds making up this five-part deal. So you've got different maturities, right? You got like a 5 year, a 7 year, 10 year, et cetera. Um, Notably, they were rated triple B by the ratings agencies, and then their peer group, they put them in the communications category. Um, so if you look at the spread they paid here, They did come to market at a fat spread. Like they paid a big concession as a new issuer themselves. Like this is SpaceX's first offering, as far as I can tell. In it's not even public bond markets, but first tap for investment grade dollar credit markets that I'm aware. And they paid an extra 40 to 60 bips of concession over what Bloomberg puts or plots out for their interpolated curve for their peer group, triple Bs, um, communications sector on the red line, and then you see triple Bs for U.S. corporates overall. You can see communications pays a slightly higher spread than the rest of the investment grade issuers. SpaceX came in. This is kind of to be expected. Brand new issuer, financials, all of that. Everybody's starting to get comfortable with this business model. Will it play out? Will it not? All of that. But there was a wide concession here for this first offering. So as an issuer, you're hoping that that compresses over time, but this is something that takes multiple years for this to play out. Like we just went through this. A very similar development, like let's say like Netflix. Like everybody, Netflix has been a part of your life if you're an American, household for it feels like 20 years now, right? First time you were
Yeah.
streaming, and when was the last time you went to Blockbuster and picked up a actual physical DVD, right? 20 years ago, right? But it was only like a recent phenomenon where Netflix kind of did like made that same changeover from a high yield issuer to an investment grade issuer, and then that same thing, a 144A Reg S issuer to a public bond offering issuer, and then you're just starting to get comfortable with inclusion into the Bloomberg US aggregate index. We've seen that with all kinds of technology names lately, Uber, Meta, et cetera. So SpaceX is just beginning its own journey through that process. But yeah, what it's actually reflecting here is just that need for dollar capital for what's in front of us is how I kind of view it.
Yep, that makes sense. And so then let's expand out then into kind of the layer below this, the actual monetary layer. For me, I saw some news over the weekend that there's been some approvals at the ECB level on the digital euro. So I know we've been speaking a little bit about all of this. Matt and I talk about this during the mind print hash thesis exactly, but. Um, Number one, this isn't saying that the digital euro is for sure going to roll out. It's a key approval that they were able to pass, but effectively this does mean that the back half of this year, I believe it's H2 2026, they'll be running a pilot. So there's going to be a digital euro. I believe there's a limited set of banks and things, intermediaries that are going to be plugged in with this digital euro. But the goal here is obviously to try to create this alternative monetary system or this monetary rail that is able to compete with U.S. dollar rails, and some other ones that are out there that I'm gonna let Matt kind of discuss. So, Matt, maybe walk us through what you're seeing with the digital euro, and how does this compare against what other types of advancements we're seeing, both on the U.S. side as well as the let's call it Chinese side.
Mhm. So in this kind of multipolar world, which is just becoming more and more emergent that we're talking about on Mindprint Hash, um, yeah, each one of these regional spheres, like everybody's going to have to go through a currency transition. Like what's the next iteration? If your currency is a Pokemon, right? What's it going to evolve into? Um, Everybody made a development on this front in their announcements this week, and we got a good kind of milestone or checkpoint for where each one of these players is along that process. Note the one we didn't get an update from Russia. It's kind of like, well, Russia of the major regional spheres, right? So that's kind of a tell.
Yep.
They're going to have to take what they can get because I don't see anything coming out of like a digital ruble or something like that. All right, so leave it like calling that out, but leaving it aside, right? Okay, so this digital euro rollout, um, what they're actually doing, like, so each one of these digital euro or digital dollar or digital you want, whatever, you just add a digital in front of it, right? What does it actually represent? Well, they're all structural changes and they're all slightly different. And then the other thing I'll focus on in each one of these cases, we've got a signal for each one of these on actual market adoption for each one, and I'll get into that. So, first, this digital euro, we talked about it, like what is it? It's really a copy paste of the old liability based offshore dollar system. What do I mean by that? It's a two-layer system where you've got a central bank money or base money that sits outside of the private sector. So you as a household or business wouldn't have access to trade, redeem into the central bank money. The same way that right now, if you're a business or household in the US, I don't have access to hold actual Federal reserves, right? They limit who has an account. You got to have a special charter, piece of
Yeah.
paper, all of that gives you access. And as we've seen in other stories we've covered, like there's a battle going on for who has access with the new fintechs, the new issuers, all of that. All right. So with the digital euro, you've got a two-layered scheme, and you can kind of see the tell here the this digital euro layer. They want it to be, when they say digital, it means it'll be on your phone, iOS, Android, whatever. You'll get an app, you'll get an account, and that'll be your money you transact with for actual real economic activity in day-to-day life. But what it actually represents in my mind is it's similar to that offshore dollar kind of liability standard that we're exiting, in the case that like the base money is just an outside um, good. It's a ledger money, but you private sector, you really don't have any access or control. It's still kind of technocratically managed. So it really represents the ECB is going after the CBDC approach, and my view is where I see this going. But notice like the digital euro, as I said, it's still a liability money, but what you're getting here is kind of that same meet the new boss, same as the old type of thing. And I want to call out in this headline or in this Reuters kind of summary, no, it's a 12-month pilot, so it's not even a real launch. It's not actual economic activity. But notice in the opening paragraph, they kind of tell you what they're trying to replace here. And it's supposed to be an electronic means of payment aimed at making the Eurozone less reliant on US credit cards. So you can see what they're trying to supplant here. You got the CBDC at the base layer, and then the second layer, it's actually the think about like the swipes of cards that
Yeah.
Visa, what's in your wallet, or MasterCard. Those are US companies operating, payment, support like at the front end, like the actual customer interaction with merchants, stores, like vendors, et cetera, like on the front lines. Visa Mastercard is what I read is what they're actually tasked with coming up with a disruptive challenge or two. Uh, Large network effects at Visa and Mastercard as kind of payment rails issuers. So
Right.
yeah, work in progress. Good luck here, yeah, ECB. Um, you're fighting a deeply entrenched incumbent, and we live in a world where everybody wants the dollar at the end of the day. All right, next up, China. They also made an announcement that they've signed up 26 financial institutions for their own kind of cross-border settlement service, real time, 24/7, all of that for the digital yuan. They call this system cross border ECNY transfer services, or CBETS. Um, that acronym, probably the letters will make sense in Mandarin Chinese, I'm guessing. Uh, so I don't see it. Oh, yeah, yeah, it is. It's cross border ECNY
Yeah.
transfer services. It's just a
Yeah. It's
weird
just yeah.
jumble of words. All right, now I get it. All right. Um, but yeah, it's supposed to be. It's the same thing. It's cross border settlement, but it's like between merchants and then the banks, and then they settle at the central bank level for overseas financial transactions. What you're trying to do is expand your regional sphere of where your currency, is accepted as, money that will spend within an economic regional sphere, right? But I saw one participant here as the first foreign bank to sign on, and highlighted here, Standard Chartered Bank, London special. That's kind of your tell here at who's developing this one. So still a lot to be desired, but this does represent, if you're thinking about like different projects, right? And you're seeing like that meter from 0 to 100% completion. 100% means it's like live in public and you've actually generated real private sector adoption for your product. All right, digital euro is nothing. It's all vaporware at this point. It's a hope and a dream.
It's
We're going to
alpha
launch
at
the beta.
best right now. Yep.
Yeah, yeah, exactly. This is like, okay, we've got 26 financial institutions signed on. Now can we get the merchants? All right. Well, there's different ways of doing that.
TBD.
Okay, so
Yep.
you're further along on that curve, and then you go to the US, and we're like, oh, this is awesome. Um, this is the headline we've been waiting for, in my opinion. It just showed up today, June 25th. US stablecoin giant Circle to start the settlement business with Namira per Nikkei Asia, right? The Asian Wall Street Journal. Just side note here, the views on X when we were considering putting in the post from the Nikkei Asia account, it had 2,500 views total, like on X, which just tells you. So Nikkei Asia is the English version of Nikkei, which is, think of them as like your Wall Street Journal, headline outlet or
Of
media
Japan. Yep.
publication. That's kind of your tell here, in my opinion, that there's very little views if like relative to how important this story is. Like we set this up in the mind print hash framework, talked about it a lot. I think the US, like investment public, is still it tells you how below the radar all of these trends are still operating, right? So where the puck is going, like there's still a lot more like catch up to do, I think, for the investment public and us wrapping our heads around what's in Japan. If you look at the chart of the Nikkei index, right, it's up at like ridiculous amounts in the last year. Um, Yet everybody's focused on the JGBs or the JPY exchange rate, all of that, not realizing this is an equity bull market underway. And then that integration between this new dollar that the US is transitioning to. We talked about the liability definition of the dollar, the offshore dollar, giving way to the asset based definition dollar of the stablecoin dollar. That's coming, right? Um, we're still very early in that process in my opinion. So yeah, the announcement here was they'll start accepting payments or settlement of cross-border payments, and then also securities trading. Namura, if for those not familiar, as a Japanese financial institution, it's their largest investment bank
Yep.
in the Japanese market, or securities focused financial institution. Um, so this, in my mind, represents real private sector adoption. Like, I mean, I don't know, governments may have like said, hey, you should do this, but this is voluntary private sector adoption, profit motivated, incentivized, all of that. We've talked about the links, all the geopolitics, the reconfiguration of international trade, and then the complement of that on the other side of the coin is the payment rails and financial settlement. That's this story right here. So huge development. Been waiting for this bullish headline. Um, you like what you see. It's like Christmas in July for Mind Print Hash and what we've been watching.
And I think
Uh,
Japan then is a good jumping off point for where we're going to go next because it's been integral to that carry trade topic that we've been talking about. Other places have talked a lot about kind of FX and all of that. So Matt, you kind of dug this up. I want you to kind of help us first by setting the context around what it is that you've been seeing and why you think there might be some future things going on in the market. I don't want to try not to spoil anything you're gonna drop on us in a second here, but effectively there's a lot going on in the insurance and private credit markets that I think you want to highlight for the audience here today.
so on the secondary market liquidity platforms that I watch as a trader and portfolio manager for our US dollar investment grade fixed income funds and accounts, I've just in my noticing the last quarter or so, I've seen the pickup again in liquidity requests for Federal Home Loan Banks or FHLB bond offerings, right? So I see that and I'm thinking to myself, huh, what's going on? And I want to just, peel back the layers of the onion and then put it in context of our framework, right? And if it foots, it makes sense. If it doesn't, well, time to update your framework. All right. So starting with that realization or that just observation, hey, I'm seeing a lot of these on my screen. What's going on? Start like let's dive in and try to get a sense of how this plays into all of the big picture, right? So headline here, this is an article dated March 26th from this year on Bloomberg, but this is like this is like the first inclination of something developing. And you know how financial markets work. The news that eventually comes to the front page headline, like shows up on everybody's radar, it's actually on page A32 or something before the fact. It's the story develops and works its way forward is kind of how these work if you think about them as financial markets developments. So right now we're still on like we're back on page A32. You can hear people talking about the intersection of what's going on here, and this story is about private credit, insurance companies, and the kind of the cross-border sovereign debt and foreign exchange carry trades, like the Japanese yen carry trade or the offshore dollar carry trade, all of that. But in my mind, all of those things, that nexus, this is what's coming to its head and working its way into the front page. So the same way that SpaceX and the AI builders are kind of rushing to stockpile dollars while the liquidity is available. Like you get your chair in the game of musical chairs while the chairs are there is kind
Right.
of how you play. We're seeing that same thing going on in the FHLB system. And just a reminder to jog everybody's memory for everyone who was paying attention back during the regional banking kind of mini crisis that developed in the first half of 2023. The FHLB operates as kind of a lender of second to last resort, right? So the Fed is the lender of last resort. It's your last stop, right, for emergency liquidity when the music turns off and everybody's scrambling for musical chairs. Think about the FHLB as like a line of defense sitting right in front of that, and the FHLB system has a broader customer base than just like the Federal Reserve, which will only um, or like primarily serves its member banks, right, for that
Right.
emergency liquidity, right? So it's the heart of the system. Um, FHLB, you can be a bank, you can be a credit union, an insurance company, a non-bank lender, or like other types of financial institution that you can do business with these banks. You just have to broadly work towards this mandate that Congress has established for the FHLB system banks that like you need to provide capital into the US, mortgage lending industry to make home buying, affordable, access, all of that for US households, right? Um, but you can think of these how they're actually used. It's kind of like a fast cash ATM pawn shop type of window. So any one of these customers can show up with like a specified list of acceptable collateral, and that would include a US Treasury bond or an agency bond from an issuer like Fannie Mae, Freddie Mac, et cetera, or a mortgage-backed security, like it's got to be related to the mortgage industry, right? And that
Right.
mortgage capital mandate, and you post that as collateral in return for a cash advance, right? And what you're doing is you're getting dollar access at an affordable rate, right? You're getting liquidity is what you're doing.
Right.
All right. So we just got the data for first quarter 2026 on these fast cash advances. And what stood out is a record level of advances going to life insurance companies, which broke the prior record that was set in first quarter of 2020. Right? Remember when we talked about we're trying to anchor our mindset. We talked about first quarter 20 or yeah Q1 Q2 2020. That was the previous like all-time high issuance as well for the investment grade new issuance market for the record month June 2026 as well. So we're seeing similar records being set across all of these different kind of milestones or signposts that we'd be looking at to get a sense of where we are in the cycle. So this data is published about a quarter after the actual activity and the results get aggregated. So this is a lagging indicator of what's going on, but it shows the trend and the direction of travel, like where the trend is moving, and like points to the underlying driver behind the activity we're seeing in yield curves, credit markets, and foreign exchange. So if you go here, this is more of a real time issuance. And so what I did is this is where someone like me who is the bond buyer, right? I'm looking at secondary markets, and I'm an investor. My accounts represent sources of capital that that would buy the FHLB's new debt issuance. And what they do for those fast cash advances, right? Your borrower will show up, they'll pledge their acceptable collateral, and they'll get that fast cash. that fast cash has to come from somewhere. So the FHLB banks, what they'll do is they'll issue debt to raise those dollars, and then they'll kick in some equity as well from their own balance sheet, and then that funds the cash advance.
I
So you
see.
see this in the chart. Like, look at this, um, like these issuance levels, and this is just total bonds issued by quarter going back for say 10 years, and you can see what's happening here. It's obvious the growth, but
Yeah.
I separated these out into coupon type because one of the other things we talk about is SOFR adoption, right? That transition from LIBOR to SOFR and how important it is. So, number one, you see like the amount of debt being raised. That's your proxy. That's your leading indicator for that need for liquidity from the FHLB borrowers themselves, like their end clients. So you see that the Q2 number for new bond issuance, we have like 5 more days in the month, so that number can go up. You can see in Q2, while we did set a record, it didn't blow out that same jump we saw in Q1, right? We had a major geopolitical development with Epic Fury, Iran, and also overlooked at this point, Venezuela on Gen 1. So
Yeah.
geopolitical disruption, all of that, that makes sense for the spike up. Q2, we're still set a record, but it's taking a breather. But what we're indicating, like we're continuing to set nominal, highs. This is incremental, right? So like what was issued in Q1, we add that on top, like Q2 on top of that. Then the other thing I want to call out, the orange line, that's floating rate debt raised by the FHLB, which is SOFR indexed. If you go back and look at all, like just sum all of those orange lines over time, the SOFR linked issuance. So FHLB has issued, I want to say it's like $3.2 trillion of SOFR indexed floating rate debt. It's really plugged into that organization or that new adoption around SOFR, which is like secured treasury repo, all of that. That is pulling away the offshore dollar activity, the liability-based dollar. It's that sucking in of the marginal dollar in the global system from, the offshore money system, fractional reserve, all of that towards, secured lending, hard money, something more like hard money lending for dollar credit creation that really originates in New York as kind of the epicenter. So
I
huge
see.
things going on, and that's pointing to um, this lender of second to last resort becoming increasingly important. So if you look at the customer composition of these FHLB advances over time, you can see that insurance companies are becoming an increasingly important part of their book of business. So their largest customer is going to be U.S. commercial banks. It's like roughly half of their book of business, but you can see that black line. There's that huge spike in 2020 and 2021, but you can see the trend. It's up and to the right. If at this point, something like mid 20s, 26%, I think, as of the last time they reported on this, and the data was December 2025, so they were 26%. You've seen the new issuance we talked about in Q1 and Q2 of 2026. I would expect that number is going up and to the right on the insurance companies. And what's going on, if you're looking under the hood, this is reflecting the insurance industry's exposure to private credit, right? Which is non-bank, non-public debt markets, dollar lending that was allowed to develop and really, grew like mushrooms in the post GFC, ZERP, QE, fiscal insanity era. That was really the core enabler behind this trend. So poster child, the case in point, Apollo's insurance company, Athene, has become the FHLB's second largest borrower in the system. And that was according to that same kind of report of the against the customer composition from December 2025 we talked about. But you can see as of 2025 that FHLB's total advances outstanding to Athene have grown past $20 billion. So I'd say it's risen to one of their top customers. We don't have any data yet for 2026, but given that the surge we saw in Q1, Q2, I mean, it's coming from multiple players, but yeah, you'd expect Apollo or Athene, the related party, to be part of that. So What was happening here? You had a proliferation of non-bank, non-public markets, dollar lending, this whole private credit trend. Um, Increasingly, you're seeing the middle market companies that those, private equity and private credit shops deploy the direct lending mostly into, are having trouble maintaining or making scheduled interest payments. They're increasingly relying on PIK or payment in
Picks.
kind,
Yeah.
which is really just saying like you don't have the actual cash, but you're paying people an IOU, right? It's the
Yeah.
Jim Carrey from Dumb and Dumber, like don't throw those away; those are as good as money. um, so yeah, that's the big picture of what's going on. So that stress. So if you think about it, these insurance companies, they're tied up. So if you're like let's say you're a Athene, like what you've done, you go to mom and pop, they show up with their nest egg. Let's say they saved up $1 million over their lifetime, and oh, we're going to retire. We need a future income stream, right? So, what do? You go to your financial advisor. He goes through his book and he says, oh, I'll go through and get you a fixed rate annuity or some sort of product like that. And this will give you your income stream in retirement. And that's in addition to your social security payments. Like your counterparty would be this annuity issuer, right? What does the annuity issuer do once mom and pop hand over their nest egg, their dollars, right, to the financial advisor, to the annuity issuer? Well, then the parent company, let's say it's Apollo here, they go and originate a private credit loan. They deploy into that. Yeah, they earn a yield spread. Let's say it's whatever, SOFR plus 700 or something. Your annuity payment is locked in, and then there's a spread there, and then Apollo's business model is we pocket that. So, it's a big go look at their financial statements. And everything works, right? You're kind of a middleman, a counterparty, a pass through. But if your borrowers are having trouble making business because, business changes or we didn't do good credit underwriting, what have you,
Rates go up.
if rates go up, if your dollars aren't coming in the door, you still gotta pay dollars out. You've got a problem, and you need to go tap liquidity, like, while the music is still playing. That's what these FHLB, advancers are. So, that's what's going on, behind the scenes. So, remember back the urban legends that have built up, the stories, the iconification of these investors like Michael Burry. I forget that whoever Steve Carell was playing in The Big Short, all of that. Um, that same thing you're starting to see happen here around this whole private credit insurance company project. And then it's also there's a cross-border element to it as well. Like Japanese life insurers were like deploying into this same liquidity pool. So there's a Japanese carry trade element to this, which impacts the sovereign JGBs, the Bank of Japan, everything going on with the yen. It's all packaged and caught up in this complex. But you're starting to see those same like Michael Burry type of stories where you've got a hedge fund manager who was on the same side of shorting the subprime into 2008. There's just one story. Lee Robinson's hedge fund in based in London is buying CDS on U.S. insurers who were overly exposed to this private credit trend. It's still small, like, there's 5.5 billion outstanding in CDS here. That's a relatively tiny amount, and then this whole private credit, sleeve of all of the total dollars of credit outstanding, like, it's 2 to $3 trillion, so it's, like, maybe, like, 1%, low single digits percent of all of the entirety of the dollar credit bubble.
So the scale isn't as big as what other people are kind of comparing it to, right? Like in
Yeah.
like oh wait, all of that. Yeah.
So if you're concentrated and you're a part of this pocket, like it will hurt. Like definitely there's going to be L's taken. So if you're tied up in this thing, you could be overly exposed. But going back to 2008, like subprime, in terms of where the credit stack was back at that point, like it wasn't, I don't know the exact amount where it was. It wasn't hundreds of trillions. Like it might have been a third the size or something like that of what it is in 2026 and what we mushroomed this thing into after Bernanke, Yellen, Powell, plus an American Congress who will pass any fiscal bill to go along with the QE and ZERP. It's we're looking at a bigger denominator, and then the numerator, even if it's roughly the same size as subprime, which it's not, it's going to be like private credit is a fraction of total subprime lending. Um, it's not going to be the same in my forecast. Like it may be proven otherwise, but 2008 and 2020, those probably aren't your like scale of comps here we're talking about. But if you're in this niche, like it'll feel like that,
Right.
if that makes sense, right? All right. So last story here. So we're working towards this, and this is the FHLB advances. All of that. We're moving towards something, and it has to resolve itself at this point. It's like that's where we're going. And the biggest story this week, if you're looking for blood in the streets, it's been in these perpetual preferred offerings from the Bitcoin treasury companies. The most famous or notable of those is Strategy or MicroStrategy, as many of us know it from the old house name. Point here I want to make, um, for everyone on like social media or watching this podcast, if you're focused on Bitcoin, like for the long term, and it's a dot now that we're nearing 2 decades in since Bitcoin's arrival in 2008, if you're thinking about this from like a Bitcoin centric process, which we try to do, but we try to not make it like so down your throat, like jam it down your throat type of thing. This process where the world is going through an organization around this ledger in cyclical fits and starts and the booms and busts. I want you to like squint your eyes at this chart, and this will help you see the forest for the trees. I think it's actually like if you look more fuzzy, you can see the clarity here. I've got Strategy here in the orange line, and then I've got the private credit and private equity major houses here: Blackstone, KKR, and Apollo equity prices. And what I'm trying to get a sense of here is look at the correlation, not in the sense of the daily moves, but zoom out over the cycle. And what you see here is they're following the same moves of like non-bank dollar credit, and the rising and falling of the waves and the tides in this cross-border kind of capital system, right? And the big picture war that we frame this as going on. So um like what you're seeing here, if you think about post 2008 GFC, legislation and regulation like Dodd-Frank pulled away this entire business of corporate lending, basically middle market. If you can't qualify for public debt markets or even for high yield offerings, you've been kind of left out and you have nowhere to raise capital except for, you'll have to turn to direct lending like these private equity issuers or private
So
equity
like
private credit.
Blackstone or something like that.
Yeah, exactly. So if you think about this peer group, right, how they differentiate between each other, you can change your capital structure on the right-hand side of your accounting T table, the balance sheet, and you can, change your composition of debt and equity, all that. And then on the asset side, you can change your composition of equity, credit, quality, or in Strategy's case, you're going to go even more beta to the cross-border capital markets, which is dollar denominated, right? You can go even more beta, lever up, and just go full Bitcoin, right? So if you think about what's going on, this whole offshore dollar, the global capital markets, they're all swimming in the same pond, right? And what we're seeing with Strategy this week and my framing, that's your outpost, your frontier credit, like new, risky, most speculative type of thing um, within this universe. And then on the asset side, all right, same way that Bitcoin has been in a market drawdown since Q3 of 2025, that same liquidity pressure, it's been building through the cycles, and it's now materializing into the equity and credit exposures on the balance sheets of these other kind of related non-bank financial firms, right? So Yeah, so what we're seeing in combo of like MicroStrategy and the Bitcoin treasury companies, in my framing and understanding of the big picture, that's just one more indication of like the bleeding edge of this big picture trend and where we're working towards in this dollar cycle. Same thing with the FHLB advances, same thing with SpaceX, and then your other AI build out firms, your hyperscalers, they're going to increasingly tap the US dollar investment grade credit markets. That's your tell that all of these players and the people who know, and they are the ones, their activity sets the market, right? We're all preparing for something bigger that's coming down the pike. So I guess we'll leave it there, but some really interesting developments this week in all fronts and where the puck is headed.
Yeah, thanks for that, Matt. I think, I was trying not to spoil anything for our audience as I was introducing the topic, because I do think that what you've identified here is, I mean, it was new for me. Really interesting to see the comparison as well from MSTR against, Blackstone, KKR, etc. I think that that was like a really key insight for me to tie that back to that FHLB piece. So again, as always, thank you everybody for listening. Reminder, Matt was on the What Bitcoin Did podcast with Danny Knowles. Take a look for that. It should be up on YouTube and all the other podcast locations as per usual pretty soon here. I'd expect the next couple of days. And then as always, please like, subscribe, tell your friends about us. It's at MindPrintHash on X, YouTube, Substack, and then follow Matt on X at LeveredUSTs and myself at Cameron Otsuka. See you all next week.